Okay, thank you very much. Can you hear me all if I just stand up and be pretty far away from the microphone? Okay. So first of all, I appreciate the invitation. I've been here for a little over 24 hours. It's a terrific place, and I've enjoyed the terrific hospitality of Maxim, so I'm really grateful. Now, something else. I need somehow to keep track of time. There's no clock in the room. Usually, no, this is so I can use my own. Okay, I apologize, but this is the first time I'm giving this talk. It's not very analytic. It has plenty of accounting, and if you want to make me feel at home, please do interrupt and ask questions. If nothing else, it will make me certain that I'm pacing myself all right, and I'm adjusting the content to what the audience knows, because there's lots of stuff here that even though I teach finance, I don't. Do you know how to make this one bigger? How do if I do start, I can.
Yeah, you can follow the time.
Yeah, hopefully there's enough battery here. Okay. So it rushes though. I don't need all the detail.
I can remind you.
What?
I can remind you of time.
Okay. So first of all, what is regulatory forbearance? It's a term that might be familiar to people who grew up in certain countries, and the idea is that there's a law and there are rules, and the regulators, the representative governments, look the other way in the service of some higher purpose. And regulatory forbearance is a well-known phenomenon in the context of financial crisis. A country, an economy reaches a crisis, and then regulators waive the rules and they say, fine, well, at least for now, we'll work differently. And the theme of this talk will be that, well, I'll try to provide a couple of quotes from past crises or how they were viewed and show that this was an important feature, and show how we entered the current crisis in the United States at least, and then some aspects of accounting. Or I say accounting and your eyes just glaze over and you say, who knows, it'll go into the, it's not accounting that goes hand in hand with the way banks are regulated. That's the key. That I'll be somewhat more detailed later, as banks are regulated through capital requirements. Capital, how much capital the bank has, is a function of how it does its accounting, and that's where the flexibility comes in, that's where the opportunity for regulatory forbearance comes in, and that has not been discussed during and after the crisis. So that's the basic theme. So here's an outline. One, I'm going to discuss briefly, and hopefully you're familiar with this, and if not familiar with this, I was not familiar with this until a few years ago. At least you'll get a sense of what this is about, accounting and how capital adequacy regulated. I'll mention forbearance in earlier crises, like in the 1980s, what's known as the savings and loans crisis. I'll provide at least one quote here, and then I'll give a couple of examples and try to, first of all, make a point that says, look, these are something to think about, wonder about, and then how markets price banks' equities. And then the conclusion is not that there was regulatory forbearance. I'm not at this point yet. I'm still working on this. It appears that either accounting is flexible and anything goes there. So the question is, what information can you learn from financial reports? And alternatively, accounting was abused, and with impunity, pretty much. So do you have a question? No, okay. If you do, please raise it. So roughly a balance sheet. On the asset side, which the left-hand side is cash, short-term assets, long-term assets. That's a generic balance sheet. The right-hand side, short-term debt, long-term debt, equity. In the case of bank, it's called capital. Short-term debt of a bank often is demand deposits. So roughly, this is what the balance sheet looks like. So even those of you, when I studied finance, I didn't see balance sheets. But even though you may not have seen those, you can, it's in the background of everything you do in finance, or a lot of what you do. So through this balance sheet picture, we can think about a few terms. Solvency is associated with the question, is the value of the assets, does it exceed the value of the promises? Right? If the assets do not exceed the promises, then the bank is insolvent. Liquidity is somewhat different. Liquidity has to do with satisfying demands or potential demands of short-term creditors immediately in the near future. So the question is whether there's enough cash here or whether these assets can be converted into cash pretty quickly to satisfy the demand here. And this is not a trivial question, it's a very difficult question. Because behind all this, there's the expectation of the bank that short-term debt will be rolled over, that demand depositors will not demand their money back. So that's by way of background. Now, what do banks do? So when you think about this, some firms make stuff, like there's a firm that makes these chairs. Other firms provide services, like the bus company provides transportation to people. Tour guides provide those services. Well, a bank does provide services, all right. Like they store your money and you can put the cash there so nobody steals it from your home, and then you can take the ATM and you withdraw the money. Great, that's a service. But when you think about the main thing they do is they transform or intermediate along maturity and risk lines. One important service that they do is because assets are longer term than debt, they provide this maturity intermediation. Now, most of the time, it works. It works in the sense that the bank lends the money 5 years, 7 years out, and raises the money through demand deposits. So it promises its depositors to provide the money immediately if they want the money, and yet the money is stuck with the borrowers for 3, 5, 7 years. Now, most of the time this works. It works because depositors don't want their money back, or as many depositors want their money back as there are new ones who bring the money in. So that's not a problem. But it's not foolproof in case all the short-term depositors come in knocking on the door and they say, I want my money back. Then a bank that had lent its money is just unable to provide the cash. Now, the other aspect of the work is that bank usually does not invest in risk-free assets. It invests in risky assets. It makes judgments about the loans. The loans are risky. So, again, most of the time, through analysis of risk and diversification, the portfolio of assets is all right. A small fraction will default, but the bank can live with this, and so can the depositors. But that's not foolproof, because risky assets can go bad. So those are the two big issues for banks and for what they do. Now, liquidity risk, I've spoken about this a little bit. So short-term creditors will ask for cash if they need the cash for consumption, for investment. Possibly the short-term creditors have borrowed money. And in this context, don't think necessarily about the household, but think about other businesses, think about other banks. Because one of the most developed credit markets is the market between banks. So a bank itself is at one point lending money, but it has borrowed funds. If its creditors come knocking on the door, it needs funds, and the way it will try to get the funds is will ask its debitors, to give the money. So those can trigger the desire for money, but they can also be the fear that the bank will not have cash in the near future. So if you have lent money to a bank and you have the right to demand the money right away, and you're concerned that the bank will not have money tomorrow, you better take it away now. And that's the celebrated Diamond Diving model, that raise the possibility of fear of asset liquidation, a fire sale price, and the usual policy response to that is deposit insurance. So the idea is that the government steps in and essentially provides another asset to the bank, which I didn't mention in the balance sheet I showed, which is the ability to call on the government to give the bank money to satisfy demands of depositors in case of a crisis. So to some extent, it addresses the liquidity risk. So any question about this? Because so far I've covered already a good deal of ground, so if you have questions, I'll be happy to entertain them. Until the first person asks, nobody will ask, but then the equilibrium is nobody will ask, right? Okay. Okay. Solvency risk. And some of the issues have to do with the distinction between liquidity risk and solvency risk, and the distinction is far from obvious, both theoretically and in real life. So it's possible that assets turn out to be bad. Then creditors redeem their claims. So the assets are not as good as people thought, including the lender. Lender is a bank. The bank's depositors, the bank's creditors say, I want my money back. And now the bank, to satisfy their demands, has to sell the assets. Now, the assets were originally thought to be worth, say, 100 cents on the dollar. And now people have the impression they're worth only 90. But now the holder is forced to sell. If it's selling, well, it's selling them at 80 because it's in a rush. And the price is 80 possibly because the bank's competitors are holding similar assets and are subject to similar pressures, and they are selling the assets. So there's a selling pressure, and then the solvency risk becomes liquidity risk. And there's a cycle between the two, because when people realize that the assets are sold not at 90 but at 80, they say, wait a second, I'm a creditor of this bank, the bank holds this thing that is worth 80, I better worry about my money. So more people are asking for the money, and now there's more selling pressure, and the price can go down, which will in fact feed the fear of that sale. So okay, now let me shift to another issue, which is accounting, and then I'll look back and connect the two, and then we'll talk about the crisis. So far I'm speaking pretty much at the abstract, although of course what I have in mind is what happened starting in 2007. So what's the value of the assets? And the question is, who should care? So here are multiple audiences and purposes. One, you're running a financial institution, you're running any institution. You want to know what your assets are worth. If it's a bank, if it's a financial intermediary, it's important also to do hedging. So you want to know what is the sensitivity to the value to various possible outcomes outside the bank, and then maybe hedge against this if you so choose. But the first step to do that is to know what value you have. So that's the internal control. Internal control, by the way, is important to the extent the bank pays its employees according to changes in values. If an employee put on a good trade, presumably the asset value should go up, then you need to know the asset value internally. Another reason, if it's a public company, it has the obligation to provide quarterly reports to the financial markets for the current holders and maybe future holders of the investors. Also, creditors, current and potential future creditors, want to know the state of affairs of the company, and again, they need that information. Then, regulators the government, if it wants to know what's going on, the first tool it has at its disposal is the reports of the regulated. And then there's the rating agencies that pronounce their grading, if you will, of the debt that it rates, needs to know what is the financial health of the regulated. Okay. Now, I mentioned regulators, and one can step back and ask, why regulated financial intermediaries? You know, there are various businesses that go without regulations, and there's no objection. For instance, whoever makes these chairs, there might be regulations of the to protect the employees, that the sanitation in the workplace is okay, that the safety is okay, but I assume there's no regulation about the quality of the product. And if you buy a chair and you fall off the chair, it breaks, you fall off the chair and you break an arm, you can sue, but there's nobody who, I suppose, I never looked into this much, nobody who, as the business goes on, sort of checks the quality of the chairs. Not the government, anyway. Now, banks are special. They're special, one, because their services are essential. Certainly it's difficult for me to imagine life without an ATM. So I can tell you. So in October in New York we had this Hurricane Sandy, and we knew about its coming a few days in advance. So what I did go to the bank and withdrew, I think, $2,000. Now usually I don't carry in my pocket more than 100, 200. Now, why did I do that? Because I was afraid that the computer system or the electricity would break down and I would be left without cash, which would have been very inconvenient. So it did, by the way, I should tell you, it did happen to me this morning. So I went to a bank down the street from my hotel and I wanted to change money, and she took the money, and then, okay, she spoke Russian, I spoke English, but I think I understood, computers were down, no exchange. So, well, that was so the service, you don't want to be stuck if you rely on an ATM, to be stuck without the banks being able to provide this. Now, but even before the ATM era, banks were known to be prone to crisis, and the crisis could easily spread from one bank to the other. So, at the heart of bank regulation is capital regulation. Capital regulation means making sure the difference between assets and liabilities is high enough so that if the asset value drops, the debt is not impaired. The debt is still in good shape. The bank can still meet its debt obligations, and especially among the debt obligation deposits. And the presumption is that there's enough time and value there that the bank whose asset value turned out to be lower than had been thought will issue more equity. That's the heart of capital regulation. Now, capital regulation in turn, sorry, let me just say a word about the regulator's perspective, and that's where the tension is when you sit back and you ask what's going on between the regulators and the equity holders. From the regulator's perspective, asset value goes down, capital should be raised, meaning equity should be sold. Shareholders don't like selling more equity. Selling more equity, on average, depresses stock prices, which shareholders do not like to see. So this is at the heart of the tension. Okay, now, another comment about accounting. And these two will play a feature later. So I've learned a little bit about accounting in the past couple of years. I think I know only the tip of the iceberg, and even there I make mistakes. There's books and books about regulation. It's very difficult to really absorb them, retain them, think about them analytically. But let me try to summarize, to mention in passing two things. Some assets, and what I'm talking about are US rules. To some extent they apply in the EU. I'm not sure to what extent. And outside that, I don't really know. So there are two types of assets for this purpose. And they are selected by the banks themselves. They are classified by the banks. One type, a type where the bank has to mark to market. Meaning, and those are mostly are securities, so they trade to some extent. So the bank owns a security, and the market price of the security or cousin of it, close substitute or somewhat more remote substitute changes, then the bank has to adjust the value on its books. That's fair value or mark to market. There are other types of assets, so that's one possible adjustment. There are other types of assets which are not mark to market. If you want to think about simple loans are not mark to market because there is no market in them, because it's difficult sometimes to find close substitutes, because the loan is to a particular person, to a particular business, and the extent to which it's going to repay depends on the circumstances of the borrower. So those are not mark to market, those are carried at historical cost, but there has to be allowance for loan losses, meaning if the banker has information showing that the loan is unlikely to pay in the future, then an adjustment down has to be made. So I'll talk about both. I guess I'll talk mostly about this later. Okay, so now I want to talk about history. So in 1991, Congress passed Fiducia. That's the name, the acronym for the law. And so FDIC stands for Federal Deposit Insurance Corporation, and that's the government-sponsored agency. It's a corporation, so in principle, it's incorporated, limited liability, and its mission is to supervise banks, and it has a fund, and it has the right even to seize a bank that it deems insolvent or illiquid, either case, and then it guarantees the depositors up to today $250,000. Before the crisis it was $100,000. And part of its mission, it should minimize the damage to the taxpayers. So the idea is the FDIC, it supervises all the banks, and then it observes a bank whose asset quality is low, or maybe the asset liquidity is low, or the banks on the asset side doesn't have liquid assets, and the liabilities, the deposits are high compared with that. It says, okay, enough, it's not being run on behalf of shareholders. We are taking over, and we are guaranteeing the depositors, and we'll find what to do with the assets on our own. Now, the way they usually do that, they seize those banks Friday afternoon, when banks are closed, markets are closed, and by Monday morning, the bank has been taken over by another bank with the blessing and sometimes the financial intervention of the FDIC. So that's the FDIC. And the FDIC had existed since the 1930s, but in 1991, there was realization that in the 1980s, a whole bunch of banks that were called savings and loans were poorly supervised, and they were in trouble. The trouble cost the United States taxpayers tens of billions of dollars, if not more, and led to misallocation of resources. So in 1991, Congress passed the FDIC Improvement Act, how to make the FDIC better. And at the heart of the matter was forbearance. Now, what is forbearance, which was the title of this talk? One, if a bank is too big to fail, the idea is if this bank fails, the economy will ground to a halt. There will be huge damage all over the place. Some people claim that allowing Lehman Brothers to fail in mid-September 2008 was a case like that, and maybe it was a mistake. I don't have an opinion one way or the other. So, you forbear. Then the idea is by the time you've reached the point where you're forced to liquidate a bank, there's a big deadweight loss. So maybe you've reached this point, you say at this point, from this point on, the public is better off forbearing, not foreclosing the bank, but subsidizing it to keep going with the hope that things would get better. Then there was a claim at the time that regulators can distinguish between losers and winners among the banks. So regulators had inside information. The bank would have to share a lot of information with them. In the crisis, so the economy as a whole is not doing well, and if we just wait a little bit, the government's policy will get us out of the slump. In particular, this bank that we are worried about will do better, so let's just wait. And forbearance for this particular bank, for the banks as a whole, is one of those policies that will allow the economy to keep going. So these are arguments that were made, and at one point the consensus was that they are not quite valid. So now we're coming back full circle. You see that banks take center stage in the sense that more capital means higher solvency. So there's less need for FDIC. And that takes us back to the measurement and its implementation. Now, economists, people in financial economics, often pay very little attention to accounting, myself included. Because we take measurement for granted. Or, alternatively, and almost equivalently, we say, look, accounting is so hopeless. If I ask you, how much is this chair worth used? If I ask you about new, you'd go to the department store, wherever they sell them, you ask for how much they sell them, and you go to 3 of them, and you know the price. Used, there's no market in these, so you can take the original price, and then you can depreciate. So accounting has its problems. Measurement does have its problems, no doubt. But here, if you want to regulate banks, if you want to understand what's going on, it's through capital. And capital is completely dependent on accounting. So that's why we are stuck. We have to understand this. So, okay, here to understand the position of one person in the US government, but she was a very important person, and what she said about forbearance. Now, this is a speech Sheila Bair, who was the head of the FDIC at the time and throughout the crisis, and she gives this happened to be in Beijing, July 2007. And she emphasizes that this law of FDIC Improvement Act is prompt corrective action. It requires supervisors to take increasingly aggressive action to control risk and minimize loss. Ultimately, the bank must either recapitalize or be closed when its capital falls below a minimum. The FDIC can act independently to close the bank if the primary supervisor fails to do so. And then, what she emphasized are prompt corrective actions, and prompt is key here. So, as soon as the FDIC sees that there's a problem, and it is defined in the law and the regulators that came with that, it has to act. There's no room for forbearance. And here she emphasizes why. We learned valuable lessons during our three years savings and loans. We learned the importance of early intervention to do with troubled banks. We learned that the bank's franchise value is preserved and the cost of the deposit insurance fund is reduced if regulators are not required to wait until all the capital is exhausted before closing a bank. In fact, the law reversed that. It required the FDIC to intervene. We also learned that supervisory discipline could be strengthened if early intervention is supported by clear legal mandates. Under current law, every bank's capital strength is measured and ranked by its supervisors. These rankings are clearly defined, and the supervisory action required by the law are transparent. These rankings range from well-capitalized to something else and trigger specific and progressively severe supervisory action as capital level falls. So we are all ready for a banking crisis in terms of the supervision. And there are mandatory actions for banks that are undercapitalized. And she goes on. So she described the situation in July 2007, like, look, when we smell trouble in the bank, not only are we entitled to act, we have to act. And remember, the United States prides itself on being a country where the rule of law, so here she is, the main enforcer of the law, and she says, we'll have to act. So now we're coming to the crisis itself. So first of all, the first question I want to ask is, where were markets? So half, roughly speaking, of banks' assets are mortgages, mortgage-related securities. So what's interesting is to see where were the markets in those securities. And what I'm going to show you are these ABX indices. Now, ABS indices are based on derivatives, which in turn are based on mortgage-backed securities. So if I had another hour, I would speak about what they were and how they were constructed, but I will not. But roughly, if you know what is the Dow Jones, you know what is the S&P 500. So the Dow Jones is written on an index of 30 stocks. The S&P 500 is written on an index of 500 stocks. So think about the ABX index reflecting roughly the price of thousands of mortgages to different households in different parts of the country. And essentially the theme of this talk, now that I've gone through most of the introduction, is the tension between what the market said and what the accounting said, or the way the banks use the accounting. So now, so this is ABX household equity starting. This belongs to the core that was born in the first half of 2006, and essentially this was January 2007, and these were different tranches of this, so they go in quality from here to here. And notice that historically they were at 100, and already in January 2007 they dropped. Now the start of the crisis is, when it was visible, is usually here in early August 2007. That's when the first signs, well, it depends. In hindsight, you can see all kinds of signs, but on August 7th, 2007, I believe, is the first time that the spread between LIBOR and the safe rate gapped from 20 or 30 basis points to 100, 150 basis points. That's usually the standard date to start the crisis. So by then, those things drop. And mind you, if you look at the purple one, it dropped to only 4%, but 4% for this particular AAA was, at the time, you stop here, that looked very unusual. And then, now notice as we go, and later we'll discuss a few cases, they took place in 2008. By then, the AAA here is trading at 90, and the AA is trading at 50. And here you see later ones, I'll have to skip that. So Now I'm going to walk you through 3 examples that each one of them is sort of, when I first came across it, I thought, that's really weird. So the first example is from March 08. By March 08, the Fed engineered the takeover of the investment bank Bear Stearns by JP Morgan. That was very, very big news. It was a huge event. And what I'm going to show you is a commentary on accounting and on how wrong mark-to-market is by the chief executive at the time of AIG. AIG is this famous insurance company that later in the crisis crashed and burned. But, okay, so let me, again, take you back so you appreciate the magnitude here. So I mentioned in passing fair value mark-to-market. So there are securities that firms that hold them, banks or insurance companies that hold them, are required to mark them to market. So here's what markets are saying in 08. Look, this is for mortgage-backed securities that were born in early 07, and the AAA by March 08 is trading at 60. Those are trades. So you would think that somebody who holds mortgage-backed securities, I'm not saying it should be 60 because it depends on the vintage. It's not 07, it's something else, maybe earlier, which were better, maybe different characteristics, but still somebody would be taken aback by these numbers. So here's a piece from Bloomberg on March 18th. That was a few days after JP Morgan was taken over. So Martin Sullivan speaks at the investor conference, some conference in Dubai, I think. That's the original news. He complains, or he looks to relax accounting rules. So I said the measurement is not good. Because of the measurement, he is forced, and he's not trying not to be, he's not abusing the accounting rules. So he's forced to take a loss of 11.1 billion, and he's taking them on his December quarterly or annual report. But he said it should be 900. So let me elaborate on this. So he's thinking to relax the accounting rules that force the world's biggest insurer to take 11 billion write down. And what he is saying, you should have taken closer to 900. So the ratio is like 12. And what he's saying to support his position, he says, he has had his analysts do a stress test, worst case scenario for the unrealized losses. And there would be no more than 900. So there's no justification in the world to have the loss, to have the write-off, a factor of 12 times. And he voluntarily says that. He's not questioning those stress tests. Worst case scenario, mark-to-market is not worst case. So he doesn't mention that he asked company analysts, because he knows what's right. And he did comply, but the point is the state of mind. And the question is, well, so that's one example, so how far can you go with that? Well, it's true, it's one example, but what you want to see is how exceptional it was. So now I'll have to take you through another institution. It's called Federal Home Loan Banks. And you can see already they have a strange name, and they're big. There are 12 of them. They are quasi-governmental institutions or fully governmental institutions, but among them, they have assets. They had assets in December 08 of 1.349, so it's well over $1 trillion. So they're big. And there are 12 of them. And here's one example. In the example, I lifted from congressional hearing. So that's a year after Mr. Sullivan said what he said. So the congressional hearing is about whether mark-to-market should be modified, whether fair value maybe is wrong, is bad, and should be changed. So here's what the subcommittee chairman says. The reality of the procyclical nature of mark-to-market accounting, it has exacerbated the ongoing economic crisis. If we do away with this standard entirely, accounting will revert to the very kind of subjectivity and sleight of hand that made mark-to-market necessary in the first. So he's not proposing to do away, it's not clear what he's proposing. The standard does provide transparency for investors, but its strict application in the current environment is in too many instances distorting rather than clarifying the picture. So there still is a big debate whether mark-to-market is good to apply or not good to apply, and he's saying, look, as we use it, it's a bad idea. And now comes the example. And here's this example. Last September, the bank estimated that's the Atlanta Federal Home Loan Bank, that it would lose $44,000 in cash flows on 3 private label mortgage-backed securities starting in about 15 years. And last September, that's even before there was further deterioration. And then comes the key sentence. The mark-to-market accounting required this relatively minor shortfall to be treated as an other than temporary impairment loss of $87 million. So when you look at these numbers, even without taking a position on mark-to-market, understanding the intricacies of that and what's this technical term other than temporary impairment, let's think about this for a second. Besides the calculation is for you that 2,000 times 44, 2,000 times this is this, so it's a huge difference. But not only that, suppose the losses were, somebody claims on this asset, the pool of mortgages, the loss was $90 million. And I ask you, so what do you think the face value of the assets is? Say, look, if the loss was 90 million, the face value could be, let's say, 100 times that, 50 times that, but that's the kind of order of magnitude. So, to make it easy, let's say it's like $1 billion, which is 12 times that. Suppose the face value was $1 billion, it was more, but suppose it was $12 billion. And I tell you, somebody is projecting a loss of 44,000 15 years out on a pool of loans that are $1 billion. I would say that's completely not credible. It's a rounding error. You're talking about loans that add up to $1 billion. And you tell me you can project a $44,000 loss, that's the only loss you can think about 15 years out? That by itself is a little strange. So, but he says that. And then he says, I find that accounting result to be absurd. It fails to reflect economic reality. So, but here's the fuller picture. Now, and the funny thing, one of the funniest things about accounting is, at some level, it doesn't tell you everything you want to know. But at another level, it tells you more once you dig into the notes, as opposed to just look at the financial statements themselves. So in fact, in the note, the bank says that the bank had a total of 442 securities in unrealized loss position with a total gross of 2.7 billion. So 2.7 is 30 times the 87 million that he was talking about. The bank recognized another temporary loss of 87 million. So he complained about recognizing an 87 million loss, when they claim that, oh no, it's just a few households will not pay us $44,000, that's 15 years down the road. But if you really mark to market, if you adjusted it to those HBX indices or the relatives, the loss would be 2.7 billion. So that, now, take a step back. These numbers are important because of the capital requirement. Because the more losses they recognize, the more the asset side shrinks. And if the asset side shrinks, that comes at the expense of the equity side, of the capital. So if the bank had recognized not 87 but this, they would have to raise more equity. So that's why it's important in this context. It's not, no, so last night, Maxim was kind enough taking me to the opera. It's not an opera, it's not a show, but rather decisions have to be made. The bank has to raise money. Now, in this context, there's a gentleman, Charles Boucher, who had been controlling general of the United States for 15 years, accountant. He's in the Hall of Fame of accountants, a first-class professional. And here's the announcement that came out shortly after, in March 2009. Basically, Boucher refused, in his role as the Office of Financial Board of Director, he was one of the people who had to sign the accounting statement of the Federal Home Bank of Atlanta. He refused to do so and resigned. Now you put all this together, and you would think there would be some investigation, none. So that's the kind of forbearance or one aspect of it I'm referring to. Okay, let me give you another example, and that would be, I think, my last. So in this example, I'll ask you a trick question. So in July 2008, and I'll give you the date, I think, Merrill Lynch announces a sale of $30 billion worth of, or not $30 billion worth, I should take it back, gross notional amount, some number, of asset-backed securities, collateralized debt obligation. And it sold them for $6.7 billion. Now, the 6.7 were carried at the end of the previous quarter at 11.1. And therefore, the difference between these two, Merrill is recognizing a write-down of $4.4 billion. What's wrong with this slide? There's something wrong here, and it's a trick question. Anybody here knows accounting rules? Well, so you're on the spot. But it's a trick question. Okay, I've run over my, yes?
I just can't see what is the difference.
Oh, I'm sorry. No, the 4.4, no, the arithmetic is right. 4.4 is 11.1 minus 6.7. That's.
Don't they have to use that value in the first line instead of in the third line?
No. The 30, no. 30, no. That's how these mortgages were born. That's not relevant. Now, okay. It's a trick question. The trick question, the answer, what's wrong, is the date. How can the date be wrong? I must have taken it from someplace. I did. July 28, 2008. The end of the second quarter. When was the end of the second quarter? June 30th. In fact, they had announced their second quarter results 11 days before July 28th. So when they announced the results, did they know that the thing was not worth $11 billion, that the thing was worth closer to 6.7 than 11? Of course they knew. They didn't sell this. You don't sell a few $1 billion worth of anything overnight. They were shopping this bundle for weeks and months. So there's no way they did not know what it was worth, for how much. Okay, they may not have known this exact number. I understand that. They may have thought maybe it's 7. Maybe it's 6. Nothing. And they are obligated to, so clearly it wasn't right. And again, this is in the public domain. You go to newspapers from those days, they were there. And no questions asked. And by the way, the person who was leading, the CEO of Merrill Lynch at the time, John Thain, had been, 2 positions prior, the chief financial officer of Goldman Sachs. So if anybody was there to know the rules, reporting rules and accounting, that was him. So the point is that they knew for how much they could do the mark-to-market. It was not, usually you don't do mark-to-market properly because there's no market. You were not in the market, you were sitting on something. They were in the market.
Oh, but, sorry.
Yeah.
I was just going to say that, like, I think it's understandable why they did it because, well, they released half a year report with like good numbers, obviously, and then immediately carried over like the loss into the second quarter. So like they have some time to fix it if they hope like by the end of the year.
They had even stronger business motives to do it. And I can talk to you about this later because I don't want to take up much time. But you would think that America is ruled by law. And the law, this particular law, is about how a bank or an investment bank should value its assets when it reports to the public. And it says mark to market. And they were not marking to market, and it's a big difference. In fact, I may have the number how big the difference is. Oh, so added to that, when they released their second quarter results, there was a conference call with analysts, which is quite common. And John Thain was saying, right now we think we are in a good position. We are well capitalized with 9.5% Tier 1 and 15% total versus risk-weighted assets. Right now we believe that we are in a very comfortable spot in terms of our capital. So notice, he's asked by the analyst. It wasn't, I don't recall whether it was a response to a question or whether he said it spontaneously, but notice the attention being paid to capital. In fact, what happened in this case, I don't recall whether I have this here, simultaneously with the sale of this bundle, this $6.7 billion worth of the collateral debt obligations, they were selling equity. And just so you understand how much equity, you put it in context, they were selling 8.5 billion. The market cap on that afternoon was 24. So they were adding 1/3 of total equity, and that was triggered by the sale of a risky asset. Usually when you sell a risky asset, you don't need to raise capital. It's when you sell a safe asset that you need to. And then he acknowledges that we would not have needed to raise more capital unless we completed the CDO sale. So it was a big deal. They knew it was a big deal. They knew it was, and not the whole, there was another issue that I don't want to talk about here because of time. So they just fudged, and it was in the open. It wasn't, I didn't do any investigative work. So now, so that's what and those were 2 examples. I have a few more. I'm trying to do a more systematic study. How did the stock market behave? And I want to introduce what's called the Tobin's Q, which roughly is, the numerator is the value of the assets as close as possible valued by the market. So that's market price of equity divided by book value of the assets. And here's the picture you see over time. That over time for banks, Tobin's Q was roughly above 1, and then in 2007 started deteriorating. In 2008, the average was a little below 1. The right-hand side is the share of banks with Q less than 1, meaning the fraction of banks that stock market says there's not enough equity there relative to the assets. And starting in sometime in 2007, it climbs until it reaches like more than half. So the quarterly statements and the annual statements were one thing. The stock market saw through that to some extent. And yet the regulators let them get away with that. Now here's another example of capital ratio. That's a bank that failed in the MAC. In its last quarter report, which was in April, at the end of March, or they released in April 08, the capital, and there are different categories, and they all are well above the threshold. So you read the report, you say the bank is in good shape. That was the last report. By the summer, they were seized by the FDIC. Another thing to ponder, if you look at the book ratio of book equity to assets of US commercial banks in various years, and these are the years of the crisis, I don't think, you look at this picture and you don't think that there was anything special about this year. Yes, 08 it was a little lower, but also, even 08, it was better than 2000, better than 87, better than 63. So we started talking about the need for regulation, and the main tool of regulation, which is capital regulation. And what you can see is during the crisis, it wasn't particularly effective. And here are, again, market to book ratios from the beginning of 07 to the beginning of 09. You see how it drops because, and they were writing off assets, and yet the market was saying that's not enough. You're exaggerating the value of your assets. In fact, and then I have something, but I think I'm running out of time. Maybe in the Q&A I'll resort to that. So let me go back to the accounting. So we discussed accounting and regulatory of capital adequacy and why we need that, why we have that. We discussed forbearance in the 80s and Sheila Baer's statement about now we are ready. And then I provided two examples and contrasted these examples with also what the market pricing of banks' equity, and the accounting is excessively flexible. So it leaves me with a question. So is accounting just so flexible we cannot rely on it in this context, or was it abused by regulators? Now, what I'm saying to you, I don't know, maybe sounds bizarre, maybe sounds completely obvious after the fact. So just to, so there are two reports where nowadays you can do word search. So I look for the term regulatory forbearance or forbearance. And this is a report which I read in its entirety, more or less. This one I just skimmed through. So this is a great document that was issued by a committee that, it's Financial Crisis Inquiry Committee of FCIC, that was written by staffers that were hired by the US Congress. It's, I think, 600 pages or so. But it's well written, it's well worth reading. And they have a narrative of the crisis. Regulatory forbearance is not mentioned. The Vickers report is the report put out by a commission in Britain headed by John, I think is his name, Vickers. And to some extent, they cover the history of the crisis in the United Kingdom. To a large extent, they were more forward-looking about what should be done. And that I read small bits and pieces, but what I did, again, word search, regulatory forbearance, not aware, but I don't know what went on. My examples are from the United States. I cannot comment on regulatory forbearance in the United Kingdom or in Europe or elsewhere. So that's.
Did you search with E between R and B? They sometimes write forbearance as F-O-R-E.
There should be E.
Yeah. Well,
thank you.
In British English.
Ah, okay. Okay, thank you. I defer to you. Ah, okay. Okay. It's okay, fine.
Oh, wait, maybe not.
No, but that's a very valid point. I mean, if I misspelled, then the search. Okay, so that's really
Difference.
what?
Difference between American.
Yeah, no, but that's if my technique. I'm sharing with you my technique. I'm not saying I read it myself and didn't find it. I said I did a word search, and my failure maybe is attributable to my spelling. Okay, fine. I'll. Okay.
What's Jamie? Yeah.
Okay, so you have questions, comments, suggestions?
I actually read that 10 is a record of Merrill Lynch for the second quarter of 2008. And as I remember, Merrill Lynch, it sold assets, it had assets mortgage assets and stipulated for something like maybe 30 billion or something like that, and he sold part of it, like maybe, I don't remember actual numbers. He sold like 10 billions for 4 billion, 10 billions of assets for 4 billions, and he didn't write down the rest of those assets, like 20 billions that is left, to the same level as.
You're asking about that example?
No, not just I just
Oh, you're proposing some.
I wanted to share that Merrill Lynch has done a lot of other things, like financial shenanigans and other stuff. Okay, I can send you later maybe that. And he actually showed it in the 10-full report, but maybe because people and investors don't carefully read that. So I don't think many people noticed about that deal and the hold in assets in Merrill Lynch at that time.
Okay, if you can say, can you send me this comment? Please email me the comment. I'd love to see it.
Yes, I think it will be available for your record.
Okay, please send me mail with this stuff and with pointers. I'll be grateful.
But thank you very much for the lecture.
Yes.
Can I push a little bit further? Should regulators have discretion or should not? Can you? Is there an answer? Is there a definite answer? Basically.
I don't know. I haven't given it much thought. On the other hand, I think when people propose remedies and say, let's change the rules so as to prevent the next crisis or mitigate its implications, one should also study the previous crisis and ask, we had a set of rules, were they really applied? There were rules, my claim is that the rules in place, now either they were bad rules because they relied on accounting and accounting by itself, maybe everything, I mean the two examples I gave, maybe it was perfectly legitimate. And accounting is like that, so the measurement by itself is so, and we have to live with that, possibly. An alternative is whoever was supposed to apply the rules and whoever was supposed to enforce the application of the rules didn't do this, and we want to understand why. And my claim is that was pretty pervasive if that was the case. So it wasn't a choice of one individual who made the wrong choice, but there was something systemic about that, and so we want to understand the mechanism, and then if we understand that, to figure out the consequences.
And then there will be an answer.
What?
And then there will be an answer to this question.
Well, it's a step. Look, I don't think we'll ever solve all the problems of the world, but you want to make progress one step at a time, I suppose.
Let me just follow up on this question, because I think it may actually come from the Vickers report in the UK, but there was this discussion right after the crisis that the role of the regulator, the banking regulator in the UK, will be taking over by a new commission that will be created within the Bank of England, and they have this monetary policy commission that will set obviously the interest rate, and they will have a similar commission that will be like prudential, I think, policy commission that would just monitor the systematic like risks within the system and like have a power to recommend certain banks to strengthen capital levels, etc., etc. And then I remember, because at the point when the issue of this new commission was discussed, many analysts would say like, look, I mean, fair enough, but first, like, there are two major questions: how would you monitor the systemic kind of health of the system? And then what would you do? Like, would you have discretion in closing the banks or not? And then there were certain voices raised saying like, look, the Monetary Policy Commission, what effectively committee does within the Bank of England, they have the Taylor rule one way or another, kind of to decide whether the interest rate should be raised or lowered. But then they have like 8 people who would vote if it's like does it make sense or not to actually raise the interest rate if it needs to be. So they have like both like the rule and discretion.
Right.
And the same might be rule, like kind of construction should be in place for the Prudential Policy Commission. So they did discuss it, like the policymakers.
Look, ultimately, when people are involved, that means there's some discretion, right? To the extent there's some judgment. Otherwise, you can take the person out of this, and you can just write an algorithm, and you said this algorithm maps to such and such actions, and take the people out of this. So ultimately, there is judgment, but then the question is, the law has to prescribe what is the boundaries of judgment. Yes?
And mark-to-market seems a perfect idea.
What?
Mark-to-market seems to be a perfect idea, no, more or less perfect. But at the same time, it seems that, of course, you can find the rules, the mechanism, the structure to do mark-to-market for on-exchange derivatives or any assets. But for OTC markets, it's very difficult to find some kind of benchmark. No, as in your examples with shares. And the current regulations, for example, Dodd-Frank Act, etc. So with their new reporting, new transparency, new clearing system, do you think that it will be enough to find this benchmark system for mark-to-market for OTC capital? No, everything that is connected with OTC derivatives, etc.
Okay, so there's a range of assets or securities. There is the plain vanilla standard commodity such as equities. They're traded active even over the counter, and it's fairly easy to market because there's an active market. Then there's the other extreme, where there is no market because it's information sensitive or information intensive, because very few people specialize in that. And then there's everything in between. So it's easy to market when something is liquid, as long as it is liquid. There's also no guarantee that it will remain liquid. As long as people are willing and happy to trade it, then that's easy. Then the other stuff, it's the other extreme. As you go closer to it, it's more difficult. And if you think, what is the business of banks? And most banks don't try to be in the commodity business because there's no profit there, because there's competition. Competition also goes along with liquidity. So, and as a business, you always want to be when there's no competition. You always want to carve your own niche and do something special where you can make money. When you do that, then the accounting becomes more challenging, or at least you cannot quite, there's no close substitutes. Because if there were, there would be competition. So you're stuck with that dilemma.
Yes, but of course, the dilemma will always stay. But do you think that these new rules, because they, for most of OTC market, of course not for 100%, but they provide some regulations and rules for this clearing, for this reporting, etc. So do you think that banks will not have many ways to to trick the system, so that they will have to, because they will be reporting about, let's say, I don't know, 70-90% of all OTC trades, so there will be some more or less stable benchmark for this mark-to-market.
I don't know, I never really studied these rules, and now the history of financial intermediation, financial services, banking, is a history of rules that banks find ways to get around them so they can make more money. So, I don't know, only a few years later you can look back and ask yourself, so what did the banks do? How were they more clever than the regulator? So, but here I'm asking a narrow question. Banks were not more clever than the regulator. The regulator just didn't want to do its job. Or maybe or as I said, maybe the measurement was just bad. But what I want is for people to recognize that. Yes? Can you speak up, please? Now, if I cannot hear you well, maybe you couldn't hear me well because of the acoustics here.
Could you please tell, are there any risks that the existence of institution of forbearance?
Are there any?
Any risk that the existence of the institution of forbearance creates some incentives for banks to be more risky, to misbehave and so on? Thank you.
Okay, so this forbearance, I think, evolved over time. The way forbearance works, at least in the case of capital regulation, is that you have a bank and the regulators come and check your books and you explain, look, this I mark this way, this I mark that way, and they let you mismark a little bit with the hope that things will get better, with the doubt that maybe you're the experts and you know better than the supervisors, which is usually the case. They let you mismark a little bit. Then a quarter or two go by, and now we're entering the crisis and things are getting worse. So now they have a choice. Do they close you? Do they apply some sanction against you? Do they acknowledge they made a mistake before? Or you say to them, you say to yourself even, this is a mistake where the markets are wrong. Things are going to get better. The rules tells you to market according to markets. But you're saying the markets are wrong. Remember the example of AIG of Sullivan. I didn't say that in the accounting of AIG in Q4 07, they violated any rule. No, quite the opposite. They follow the rules. But Sullivan says following the rule is insane because the rule calls for recognizing a loss which is 12 times as big as my worst case scenario loss. So he just does not believe in marking to market. He said market to market is a good way. And he just thinks the markets are so crazy that it's inappropriate to apply mark to market, to make the exception. That was the mindset. So you start with that mindset. And sometimes markets are wrong. I'm not saying that markets are always and everywhere deliver the right price. Whatever that term, even the right price means, I'm not sure I can define it. But so you have to think about this. It's not a plan at the beginning, hatched at the beginning. Let's rob a huge bank. No. It's something, it's the duration that takes place over time, and gradually, both sides, the regulated and the regulator, find themselves more and more committed to this way of thinking. And then it's a little, how do we get out of that? Do we acknowledge earlier mistakes? Do we now we have to raise lots of capital? By the way, my claim is that had the regulators insisted on more appropriate mark-to-market, possibly the financial intermediaries would have raised more capital starting in 07. Now, it's not that they didn't raise capital. If you look, that's the part that I skipped. You look at banks. Can you read these numbers in the back? Can you read these numbers? No. Okay. So only people. So I'm sorry. So these are from Q3 07, Q4 07, all the way to Q308 and then the total, you see the amounts of both losses recognized and capital raised, and you see that roughly for the banks as a whole and across the different banks, they were more or less catching up. They acknowledged certain losses and they were raising capital roughly, in some sense, the same amount. Okay, it's not quite, it's not strict math, but roughly that's the, but the problem is they didn't recognize enough losses in a timely fashion, unlike these. These were, here markets where the mortgages or derivatives on the mortgages were trading directly. And so here people were buying and selling at these prices. Whereas the bank just settled these things. So did I answer your question?
Yeah.
Yeah? Okay. More or less. Do you want a follow-up? I mean, because I got sidetracked. And yes?
I want to clear some regulations wants to separate commercial banks from investment banks, and I want your opinion on that. Will it work, and when will it be, and will the government want to save investment banks after they're separated or not, or will they want to save Goldman Sachs, which is essentially now an investment bank?
I don't know. The separation, there's no separation, right? In fact, Goldman Sachs and Morgan Stanley, the two big independent investment banks remaining, in September 2008 signed up to become bank holding companies. So they are, at some level, commercial banks, right?
Yes, I found that regulators considering of separating separating investment business from commercial business, so that if a bank is going to fail, they will save only the commercial banking part, and they will let the investment banking part.
Yeah, I don't know. I mean, we mentioned the Vickers report. In fact, the main recommendation of the Vickers report, as I understand it, is that the government will provide strong guarantees to what in America would be called commercial banks, and let the investment banks fend for themselves, and if they fail, they fail. This whole hour and a half has been devoted to regulatory forbearance, but part of that forbearance, maybe in times of crisis, you don't let even investment banks fail because you're worried about implications. So I don't know. I wondered about this when I read summaries of the Vickers report, how can that commitment be credible?
Well, I mean, at least in Britain, as far as I know, like the, say, Royal Bank of Scotland, they had this GBM division, which is essentially an investment bank branch of Royal Bank of Scotland, which is, as a whole, is a commercial banking business. And they, I don't know where things stand now, but the kind of the vector of the direction of the movement was just to kind of branch out or separate the GBM business completely from the rest of the business, from the commercial banking division. So that's basically in no way GBM could use money from the commercial branch.
I understand, but look, Bear Stearns was an investment bank, and the US government chose to subsidize its rescue, essentially.
Yeah.
Lehman was not rescued, and some people claim that that was a very bad choice. As I said, I don't have an opinion on that. So it's not really clear how the authorities will behave. The next crisis will not be like this crisis. And the beauty of crisis is that they are different, and this is not, see, medicine. Yeah. Physically we get into crisis, I mean, we all die at the end. But medicine has the benefit of studying hundreds, thousands, tens of thousands, millions of people, and to identify the commonalities and what treatments can. Not here. Here, every story is sort of, there's some analogy to a previous story, but not quite. So what's new, what's not new here? Reinhard and Rogoff wrote this beautiful book with a great title, This Time is Different. It's very tempting to come up with this argument like, so, okay, I know in the past it was such and such, this time is different. And again, I want to take it back to this talk. You're trying to, with your questions, you're trying to get me to branch out on various things about which I haven't thought, I've thought, but I don't really have much of an answer and anything new to say. But here, the point is, there were rules. It wasn't like there were not rules. It wasn't like they were not clear. But either the measurement was bad, in which case that should be put on the table and be discussed and not be relied upon, or understand that reliance upon it is not a good idea, or the rules were not followed. And then, again, well, maybe some people should go to jail for that, maybe not, but the main thing is we want to understand why. If you understand the mechanism, you may be able to set up reasonable rules for next time or reasonable expectation for next time. Because another crisis will come. That's, maybe not in my lifetime, but that's just the nature of financial markets.
The regulator is always just one step slower than financial participants.
Pardon me?
I think that regulators are always one step slower, and financial participants are one step ahead in preparing.
Right, but again, taking you back to my talk, I've showed you two instances where at least after the fact, it appears that somebody should have been punished. Or there would be a conclusion that accounting was completely inadequate. Neither one has happened.
We have time for one more question, please, and after that we'll wrap up.
Yes.
Thank you for this lecture. I have a question which might seem a little bit strange, but we're talking about the competition, about the regulator of the market, and you say that sometimes banks are a little bit smarter, or they think they are smarter when they use some accounting standards during their work. But for me, it's they are not smart enough. That's why we need to intervene on this market, because if they didn't recognize their losses before the crisis in appropriate amount, after that they got losses due to the market price fall. So it means that they were not smart enough to prepare their accounting balance sheet in an appropriate way. So it means it's like the intention for intervention on this market is just that the banks are not smart enough. It wasn't clear, the idea.
Your idea? Yes. I understand, but what's the question? I'm looking for a question.
The question is that intents for regulator is to help banks to make the appropriate steps or forbid their abusing the rule.
And they didn't do that. Look, first of all, I agree with your observation that in general bankers are going to be smarter than regulators. The reason is they get paid much better, so they can attract the smarter, more skilled people. In fact, years ago, a friend who was a banker told me that the regulators would go, he was pretty high up in trading something, would check his books, and every time the regulator was really good, the bank would hire him. That's the way system. So clearly the regulator, in that respect, the regulator is at a disadvantage. The question I was trying to raise is whether regulators follow their own rules.
Perhaps I might continue with this question a bit. just what incentives of regulator have when he takes decision to make more new trade groups. Just thinks about the banks, the depositors, if they think about commercial or mixed banks, or has thinks about some other things. I will just illustrate an example. For example, after the 2008, the share of foreign bank business in American markets, they all get much bigger. And in 3 years, the most profits and in this sphere has centralized just several American banks do much better than European and partly better than Chinese. I mentioned Goldman Sachs and so on. So the regulators might think just how to, for example, to increase the number of foreign banks on their market in Greece, and taking this into account, they choose a time when they should invent new regulator rules and so on.
Wait, I didn't follow what is your question again?
The question is, what do regulators think when they think about inventing new rules? And
look, somebody said that legislation is like making a sausage. You put in all kinds of things and something comes out and you don't want to see the process. No, clearly the process involves a lot of lobbying from various groups, and then there's an outcome and some public relations around this outcome. I mean, if you think that all rules are meant to serve the public, that's a delusion, I think. But okay, but I spoke about, pretty narrowly about these capital requirement rules. Okay.
But when the higher capital requirements and so on, the lowest level of competitiveness of the banks on the worldwide market. No?
I'm sorry, what?
The higher requirements, the lowest level of competitiveness of your country's banks on the world.
Hey, I know the higher capital. Okay, look. Now it's being pushed by two friends of mine, Anat Admati and Martin Helbig. They have a book on that, and they say capital should be higher. Let's just make it all equity. Let's say that anybody who wants to lend money should fund it with equity. Done. If you want to say how much capital there should be, or more and more, the question is, what's the limit? And the fact is that banks historically, the business was to borrow money on the one hand and lend money on the other hand. That's the now. I'm not sure that we understand very well the economics of this business, the theory of why it should look like that. But if you want to argue more is better, then take it all the way to the limit and say 100% equity. Do you want to live with that? Thank you.